In this video, we're discussing one of the most important topics for emerging hedge fund managers and private investment firms in 2026: how to structure performance fees for high net worth investors. If your fees are too aggressive, investors walk away. If your fees are too low, your business becomes difficult to scale. Hey, this is Frank Nagy and welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. The goal is to create a structure that aligns incentives with rewards and performance and protects investors and still allows the firm to grow. Traditionally, hedge funds use the famous 2 and 20. That means 2% annual management fee under assets under management and 20% performance fee allocation on all the profit. But in 2026, the industry evolved significantly. High net worth investors are now demanding lower fixed fees, stronger alignment, better downside protection, and more importantly, transparency. Today, many emerging managers are using 1% management fee and 15% performance fee, or 1.5 and 20, or even performance-only structures. The reality is this: investors are no longer paying premium fees simply because someone launches a hedge fund. You must justify the compensation through risk management, consistency, communication, and operational quality. Hiring experienced hedge fund consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your hedge fund or offshore broker-dealer. A good consultant will make the proper introductions with fund administrators, prime brokers, bankers, and auditors that will help your hedge fund or broker-dealer grow. Now let's separate the two: the management fee. This is the fixed annual charge on assets under management. It helps cover expenses such as operations, compliance, technology, research, administration, and staffing. For emerging managers in 2026, management fees are often between 0.5% to 1.5%. Performance fees. This is where managers participate in investor profits, usually 10 to 25% of the net profits. This is the incentive component. Sophisticated investors generally prefer lower management fees, but are willing to pay meaningful performance fees for strong returns. That's because they want managers compensated for results, not simply asset gathering. One of the most important concepts in fund structuring is the high watermark. A high watermark means you only earn performance fees on new profits each month. For example, if an investor loses 10% one year, you must recover those losses first before charging another incentive allocation performance fee. Most serious investors require a high watermark. In fact, all my documents that I prepare my clients have that in there. Without one, your structure may appear inexperienced and investor unfriendly. In 2026, investors are increasingly reviewing downside protection, drawdown recovery, and manager alignment. A high watermark demonstrates fairness and professionalism. Another popular structure is the hurdle rate. This means the manager only earns performance fees after exceeding a minimum return threshold. For example, the first 5% or 6% of annual return goes directly to the investors, and only profits above that hurdle are subject to the incentive fees or performance fees. This model is very attractive to family offices, accredited investors, and institutional allocators. Why? Because it creates stronger alignment between investor success and the manager's compensation. Many private investment vehicles in 2026 are using a 5% preferred rate of return with a 15% to 20% performance fee. On top of that, one of the smartest strategies for emerging managers is using founder shares. For example, your first $5 million of investors may receive a reduced management fees and lower performance allocations, or a lifetime preferred terms. For example, standard investors may, let's say, pay 1.5% to 20% performance fees, and a founder's interest will pay 1% and 15% performance fees. And this creates urgency while rewarding early supporters who took initial risk with your firm. Many successful funds use founder class shares during their launching phase to attract seed capital. And now let's discuss some common mistakes. Mistake number 1, ongoing institutional level fees without institutional level infrastructure. Mistake number 2, ignoring liquidity terms. Your fee structure must match redemption frequency and lockup periods and strategy liquidity. Number 3, created overly complicated structures. Sophisticated investors appreciate clarity. If investors cannot understand how profits are calculated when fees are charged or how losses are recovered, you may lose credibility. And finally, mistake number 4, failing to align interests. The best managers invest substantial personal capital alongside of clients. Nothing builds trust faster than knowing that the fund manager has skin in the game and participates in the upside and the downside. In 2026, performance fee structures are no longer one size fits all. For emerging managers, simplicity and fairness usually outperform aggressive pricing. Hey, if you'd like to learn more about how Frank Nagy Financial Services and how we can set up your hedge fund or offshore broker-dealer, click on the links below in the description box.